Welcome everybody, my name is Michael and today we're discussing about I-bonds, inflation, and the Euro USD flippening. Interesting. So the Euro most recently fell down to the same value as a dollar. 1 euro was equal to 1 USD. And I-bonds are now coming with, at least for the next 6 months, you're locked in, but they're coming with an APR of 9.62%. This is the highest we've seen ever. And also inflation is the highest we've seen at very near to that, at 9.6% of inflation. One of the highest inflation rates over the past 40 years. So let's discuss about stuff that's not crypto, but definitely impacts the prices of cryptocurrency on a daily basis. The macroeconomic events outside of cryptocurrency, which impact every single one of us who is investing, and therefore impacts Bitcoin, Ethereum, and 20,000 other altcoins. So guys, today we're doing a little bit of a personal finance video. Guys, thanks for coming in. I really hope you're having a great day. And let's discuss about major crippling depression. I mean, inflation. And the economic world is falling around us. So first of all, the euro. Oh my goodness. I remember when euro was 120, 130 to a dollar. It always, since I was born, it's just crazy because every single time I went to Europe, I've lived in Europe for 4 years. I went almost every single summer of my life to Europe. I spent so much time over there. In total, I probably spent 5-6 years in Europe, and we've used the euro a lot. In Poland, we don't. But it is insane because I've always remembered it being a value much higher. And now it went down. Just like the US dollar is falling in value. Yeah, so inflation definitely throws a wrench into things. And some of you might be wondering, well, if the dollar is losing its value and the euro is losing its value, what is the ratio of Bitcoin worth to the dollar compared to, let's say, 5 years ago? That is a fantastic question, and there is an actual great link that I'll link down below, which features the price growth of Bitcoin according to the US dollar inflation rate. So this already calculates it with it. I know I kind of probably explained that bad, but you understand what I mean. The value of dollar falls down, the value of Bitcoin rising is different, but over the years, it's calculated below. So here on TradingView, we can see the Bitcoin to the money supply of the US dollar. This is a chart of over the past 5 years. This is going to be linked down below from TradingView. It's basically going alongside inflation. So the euro has hit a level that hasn't been seen since December 2002. In 2008, we were close to over 1.5 per each dollar, and that was because of the 2008 recession. So the US dollar lost a lot of value. Foreign investors are now investing into the US dollar, which is devaluing the euro. So the euro dollar parity has happened yesterday, and then it actually fell below. So 1 euro was worth less than a dollar. So the currency, the most remarkable thing is the currency dropped by crazy amounts really, really fast very recently. So it has slumped more than 11% this year. It's shared by over 19 countries in the European Union, and it was historically one of the safest places to park your money. The US dollar has strengthened against almost every other major currency in the world. In recent months, part of this destabilization is what's been going on in Europe itself, the war and gas prices and all of the political turmoil around that. And then, of course, the recent recession and crazily rising inflation rates. So the fact that it fell below, now it's returned, now it's still at $1, 1 euro. The European Central Bank is rising interest rates just like the Fed. And right now, as of June, each month after the end, the rates are published. In the Eurozone, the inflation rate is at 8.6%. It's possible it could continue rising. And a weakening currency will make euro imports go up. So especially goods that are priced in US dollars, such as crude oil or any commodities. Now, when we go on to American inflation, as of the past month, it was announced at I said previously 9.6, it's at 9.1%. This is over the past 12 months, and each month it's updated. This is the highest since 1981. So 2008, there was a crazy recession. Back in the 80s, there was Black Friday. And now 9.1% means that if you were purchasing something earlier in the year, last year, for $10, it would now be worth $10.91. So this is assuming it's completely consistent across various goods and services, which we know it's not. Just today, watching the news, ABC7 said in New York City, if you purchased a building and then you rented out each unit, as of last year, you would be up 40%. So now the average rate for one bedroom is at $3,600. This is a crazy amount. In Chicago, it's almost up 20%, and then it obviously differs whether it's a one bedroom, two bedroom, three bedroom. There's certain products, such as used cars, that are well up over 20, 30, 40%. There's some products that are lower than the inflation rate, but they're still up a couple percent. So either way, it is a giant increase. 9.1% is more than the UK is. They're also at 9.1%. Europe is at 8.6%. It's great that the dollar is strengthening against the euro, but there's not much we can do about it. And we know that the Fed is planning to hike up interest rates as you know, over the past couple of months. They have been increasing that, and this is their way of essentially trying to fight inflation, even though it's not really helping. Now, in terms of I-bonds, statistically, bonds have not been a great investment. Usually, they're much lower in terms of the actual gain that you get than inflation is. So you're actually losing money technically. But if you were to stuff money under the mattress, it's better to make some money, right? The one big thing, the negative about bonds is, with I-bonds, you can only have a maximum of $10,000 invested into it. And there's some larger investors that would like to park more money. The historical average for I-bonds is at 3.42% ever since 1998. So the fact that currently it's above 9%, this is due to the recent inflation rates. However, they're not perfectly liquid. You cannot cash them out very quickly. And if you cash them out before the time is up, which usually is 5 years or more, you actually lose the interest rate for the last 3 months. So the interest rate falls down a little bit. You can only do $10,000 a year. You're limited with the interest. The interest is changing year to year and even every quarter. And the last thing is, it's very difficult to purchase. Going through the government website, it's much more difficult than going through Vanguard or even going through a cryptocurrency exchange and trying to purchase. It's very difficult for the average person. Now, this is not going to stop people from investing, but it's not something that's very appealing. So you will have an option of either cashing out within 1 year all the way up to 5 years or so. It can be a good place to protect cash that is, for example, for a college fund, or for a car, for a down payment for a house, something that you know is later on down in the future, not going for that right now, but it's better than putting it into something risky and potentially losing it. You're not going to lose really your money through bonds. However, you're not really going to gain a lot. And due to inflation, right now it's at 9.62%, but this is going to be reevaluated. So an I-bond is a financial product that is offered by the U.S. government. It offers a rate of return. For example, you perk $1,000 in I-bonds, and 2 years later, you can cash them out, and you get your $1,000 back plus the interest. So with 9.62% interest rate, you would get around $1,201. Okay, so you made $201. However, that is if the rate is constant. But it's not. It's a variable. It's currently at 9.62%. However, gains are not subject to state or local taxes, which is great, but they are subject to change every couple of months. You can only buy $10,000. So again, you can only buy $10,000 per year. You cannot redeem them in the first year. Rates can fluctuate and potentially go down to zero. They're not as liquid as cash for the short term. They're not as profitable as stocks for the long term. They're kind of a hassle to buy. There's a lot of negatives against them. And when you compare it against the S&P 500 and index funds, the rate of return over the past decade, if you had money parked in the S&P 500, you would have 3 times the return compared to I-bonds over the past 20 years. Most likely, with the historical average being 3.42%, maybe with inflation now you're going to get a little bit more, the 9.62% rate is going to fall. Most likely, let's say you're going to get 4 to 5%. which at that point, some years with inflation being much higher, you're going to lose money. But it is something to consider. It might be a nice option for medium-term savings for larger purchases. Ultimately, it's a very conservative option, especially when you're coming from the cryptocurrency world. But it is something to consider with the way the world is going right now. So we've got the euro flipping with higher inflation rates, and now we've got even the government trying to raise the bond APRs, hopefully gain more interest. Now, is it going to work? I'm sure some people are going to get into it, but I personally don't care for bonds. Never have, never will. This is not something that is important. I think that you're able to make a lot more money, for example, going into the S&P 500, index funds, retirement funds, whatever. And if you want to play with a higher risk, go into crypto. That's it. Bitcoin's going to be a safe choice for the riskier options. It's going to be medium risk. For higher risk, you could definitely go into DeFi. For lower risk, definitely the index funds. So that's pretty much it for today's video. Thanks so much for watching. Have a great rest of your day. Take care. Bye.